The Australian share market performed well in the financial year just ended 2017-18, with the All Ordinaries Index up by 9.1% and the ASX 200 up by 8.3% to around 6,195 points, around the highest levels in a decade. And we estimate that those bourses came about 26th out of 73 global bourses, and of those bourses, 26 recorded declines over the period. And what we saw in particular with the ASX 200 was particularly strong performance over the June quarter of 2018. The ASX 200 rose by 7.6% and the All Ords rose by 7.2%, which was the strongest outcome in about 3 years. And if you look at what occurred towards the end of the financial year, we saw some of that risk-off sentiment, particularly around trade wars, really contributing to an uplift in the Australian Stock Exchange. We saw the Australian dollar fall by 4% over the financial year. Certainly those companies that generate earnings offshore were strong performers, particularly the likes of Macquarie Bank and Aristocrat Leisure. At the same time, if you look at the composition of the ASX 200, it's quite defensive relative to those Asian countries when it comes to some of the sectoral elements of the market cap. So about 30% of the ASX 200 is comprised of consumer staples, REITs, healthcare, utilities and the like, so been quite defensive in this environment. And at the same time, we've seen the fact that the Australian market is more attractive from a dividend yield and valuation perspective also come to the fore. At a company level, if you look at what occurred, a couple of the technology stocks, Appen and Afterpay Touch, were amongst the strongest performers over the financial year, up by 235 and 217% respectively. Those technology stocks mirroring the performance largely of those FANGs in the United States in particular. And if you look at the subsectors, of the 21 identified sectors, only 5 recorded declines over the financial year. In particular, autos and the components associated with that were up by 42%, followed by pharmaceuticals and biotech companies up by 39% and energy up by 38% on the back of that strong rise in the oil price. At the other end of the spectrum, telecoms fell by 35%, led largely by decline in Telstra, of course, and utilities were down by 5.7%. If you look at more of the sectoral composition as well, small caps or small ordinaries were up by 21%. So those cyclical stocks, those growthier stocks were quite attractive for investors in the improving Australian economic backdrop and the environment of risk on. And certainly if you look at those companies, they tended to outperform the mid caps, which were up by around 11%. And also the ASX 50 companies, which are up by about 7%. So really, the mid-caps did perform quite well. Certainly they're more diversified as far as their composition is concerned, and also in terms of capital allocation, they're also a beneficiary of that, but certainly outperformance relative to large cap stocks. And if you look at the overall total returns of the Australian share market over that 12-month period, the All Ords Accumulation Index was up by 13.7%, and you compare that to the residential property market, which is up by only around 3%, and also government bonds at the same levels. Certainly outperformance now for equities versus some of those other asset classes. And in this environment, capital preservation and certainly diversification are critical, with market volatility increasing at the moment. We expect the All Ordinaries to finish the year 2018 around the 6,500 level, certainly supported by above average earnings growth at the moment. And certainly if you look at the resources sector in particular, valuations there are quite attractive at the moment. Commodity prices are lifting despite some strength in the United States dollar, and we expect that sector in particular to support the broader market going forward.